right. Somebody chat in there. Let me know that it's working before we dive in.
We can see the screen in both of you.
All right. Right. Great day, Jay. Right on. Give people a minute or two to get logged in, find their link. Stan, thank you. Hi, Stan. Hola, Sheila. All right, everybody can see my screen. All right. The opening slide. I think Janae has the power to mute everyone. We'll just use the chat feature for today. For all of those that will watch the recording later. Okay. All right, we're 1 minute in. Everybody can see the screen okay. I am going to start to gradually dive in as we have other people join in that we had registered. Welcome to Lunch Money, episode 1. I am very excited to have everybody because I've been waiting weeks and weeks to talk about this. So very excited the day has finally come. My name's Trevor Hammond. For those of you I don't know on this, all the guests of NEO, I am your host. But to be honest, every one of the NEO advisors is the host today. We are all here to help educate and empower those of you that are watching live, of course, and are going to be watching the recording because obviously we are in the middle of the day for many people, and it's hard to watch the live event all the time if you're at work. So welcome everyone to Lunch Money episode 1. We really thought, I thought of this idea for this event probably early 2021 as we were all stuck at home. So funny story, but you see our favorite restaurants shutting down with the COVID pandemic, stuck at home, people losing jobs. And I remember I kept thinking, we have got to figure out a way to get some of the tools and the education, the resources out to the world, out to the homeowners that we have. And we have been doing that along the way, but here we are. Here we are 3 years later, I guess a little over 2 years later, bringing this out to the public, so to speak, with this idea of lunch money. And we're starting with a topic I thought would be near and dear to just about everybody that could possibly make this, or all of those of you watching the recording of this. It would be, it'd really be something that we've all aspired to do. We all want to be mortgage-free someday. We want to head into retirement years with no debt. So as we go through this together, I want you to think about what your goals around having no mortgage someday are. I'm going to ask you that question. We're going to ask you to contribute some to the chat as we go along. And Janae, you watch the chat because I'm going to be focused on the content and sharing. But at the end of all of this, and why we're going to have this event, and we're going to have events in the future for you that we think will help you as homeowners, is really to help you get the most out of your money, out of your mortgage, and out of your life, because they are all connected. And I'll be unpacking that as we go through the agenda today. Just to get started, I know some of you are already chatting in there, but chime in, just a yes or a no. Get used to the chat feature in Zoom here for some of you who aren't as used to Zoom. We're on it every day of our lives, it feels like. Have you ever, or are you currently prepaying your mortgage? You can just type in yes, no, a Y or an N. Just want to start with a real basic question. Get everybody engaged. This is a somewhat collaborative event, even if you can kind of be behind the scenes, be behind the cameras. But have you ever considered accelerating your payments? That's why we're here today. Are you already doing it maybe? Maybe it's a current strategy you already have. So type that in. Janae, what are we seeing? Are we seeing people?
We're seeing some no's, a couple of yeses. It's pretty even right now, actually.
All right.
Amberly says $2.57 a month. She's on.
I love it. I'm gonna have to find out off this event how she came up with that number. Great. All right. So for those of you not as familiar with NEO Home Loans and why we're here, why we're hosting this for you, NEO is Greek for new. Okay. And we are, everyone here at NEO, we are so committed to changing this mortgage industry for the better. And really, it stems from this passion for financial education and bringing tools and resources out to everyone out there that owns a home, has a mortgage, and is trying to get where they want to be financially someday. I think most of you, if you've ever gotten a mortgage, if you own a home, you know what most of this industry is like. You know, most people in this industry hand you a big pile of debt that we call a mortgage, wish you the best, and off you go, and they hope that you call them in 7 to 10 years when you need to buy a new house. That is not how we look at this at all. We are here to truly be a more proactive resource for you, which again, this is just one of those examples of how we're doing it. We don't feel our industry, it's enough to just help you be a homeowner. That's great. There are life events that will happen, moving up, moving down, moving sideways, buying investment properties, second homes. There are those needs that we are here for you, but just helping you get into a home is not enough, in my opinion, and those of us here at NEO. Our belief is that we have to help you be successful with your money, and there's so many things we can do for you during your years of homeownership, not just when you need a transaction. So what I want you to walk away with in this event, number one, I want to help you gain a new perspective on how to make these decisions around prepaying my mortgage or not, and how it impacts the rest of my financial goals. All right, a more clear understanding of what your NEO mortgage advisor might be able to do to help you in your life. It is not when you raise your hand and say, hey, I need to borrow a bunch of money to buy that house. We are here for that. That's great. But there's so many times in between as you're making money decisions that we can help you along the way. And then finally, obviously, this event today that you're watching live, watching recorded later, and some of your homework, I will let you know you're going to have a little bit of homework. It's going to be very easy homework, pain-free homework. But when you spend a little bit of time, as your homework will be, with your NEO mortgage advisor, you will have a more confident path. I want you to have a clear, confident strategy on how to handle your mortgage and any other debts you have, any other extra cash flow you have. That's what I want you to really walk away from this experience with us. So I'm getting texts of people who can't get in. So watch for that, please, Janae. Angela's trying to join, but not working. So go ahead and I'll let you work on that. So all of you guess, why are you here? That's what I want you to think about right now. You don't have to put this in the chat, but if something compels you to tell us something when you got the invite made you say, I want to be on this. I want to hear what they have to say. I want to learn. Those of you watching the recording later, which I know will be many people, why are you investing the time to listen and watch this webinar, this educational event? As I go through this journey with you, I want you to understand that I'm going to talk a lot about mindset and skill set. And we're going to cover both. And so mindset, when you think about it, as I go through some of these slides for you, it's everything you're learning, right? It's your attitude about things. It's your beliefs around money, around debt, around housing, around savings, spending. It's being open-minded to other perspectives, right? Am I open-minded to somebody else's perspective or beliefs about something, even if it conflicts against my own or what I was raised to believe, right? That's all mindset. Skill set is how I go apply this. So everything you learn today that we go through in this conversation around how I handle my mortgage debt and prepaying it versus investing, I want you to think about it through this lens of what do I believe? Why do I believe it? And what are my actions and behaviors then as a result of that? All right. So skill set is how do I go apply all of that into the world, into my own world of my finances, right? My savings and my investing and my debt elimination, my behaviors. And I don't know about you, but whenever I can learn a little bit of glimpse of kind of how the world works, so to speak, I feel empowered. I wanted to share that with you today as you think about your money, and I'm setting the table for you to really make the right decisions from here on out. If I'm not happy with my results, whether where I'm at financially, could be relationships, which is not the topic for today, my ability to save money every month, my path to retirement, when I hope and what I hope it will look like, I simply can kind of turn around and look at my behaviors. So my behaviors directly impact my results. And if I want to go a little bit further, I'm not quite sure on why I'm making those decisions or why I have that strategy in place. Go one step further back and look at your beliefs. You know, what are my beliefs around that, around savings, around debt, around mortgages? And what I found, and I hope you find it too, when I'm giving it to you in this from this angle, is I can make the changes necessary. If I am not on the path right now, and I can't go back and plant a tree a year ago, I can start planting that tree today, change my behaviors, and improve my future results. Right. So I wanted to set the groundwork for you out there with any aspect of your money, and anything you might be not happy with where you're at currently. You are empowered to make those changes. About 15 years ago, I got together with a good friend of mine, a mortgage colleague, and we sat there and we asked ourselves the question, what is holding everybody back? You know, before I can get into advising somebody to pay extra on their mortgage or invest those dollars, let's get clear. Let's zoom out on what is really holding people back financially. Why are so few people in America not on track to financial independence? And I define financial independence as no longer having to work for money. Now, some people will say, oh, that's retirement. Maybe, but maybe some people out there want to be financially independent before they truly retire. So I can truly work for impact, for purpose, right? Do things I enjoy and I love. So it doesn't necessarily have to be retirement, so to speak, but a lot of people do equate those two things. Well, we came up with 4 key areas that we called blind spots. Number one, we found that too many people lack a plan. And, you know, they wanted to save more money, but they didn't really have a plan on how to do that. They wanted to get out of debt or retire debt free. They didn't really have a plan on how to do that. They wanted to get healthier, but they didn't necessarily put a plan in place on how to do that. All these things, they lacked a plan. The second thing we found when it came to money is a severe lack of financial literacy. The schools are not teaching people enough. We're getting most of our advice from our parents who didn't have anybody really advising them either, other than their parents. We are not really a society of self-learners for the most part, because we're busy with work and family and hobbies and all these other things we'd prefer to do. So a lack of financial literacy leads to the third one, where we tend to store money in inefficient places, right? Whether I have $50 or $500 or $5,000, where do I store it? Where do I put it? Right? Do I put it into this college fund for my kids someday? Do I invest it in stocks and bonds, mutual funds, put it in my retirement account? Do I pay down my car loan with it? Do I pay down my mortgage with it? Do I stick it under my mattress? What do I do with my money? That's a result of 1 and 2, lack of a plan and lack of financial literacy. And then the biggie, right, which I like to call the umbrella over all of this, is lack of a wealth team. And as I walk you through this, I want you to think about, okay, where do I have some blind spots? Because we all have them. I pay a tax professional to do my taxes because I have financial illiteracy in a lot of the tax laws and ways to save money on taxes. I need somebody else to put my will in place. I'm not an expert in that area. Okay, so a lack of a wealth team means I don't have all of the right professionals in each area, whether it's real estate advice, investment, financial advice, insurance advice. We raise our hands, obviously, here on liability and mortgage advice and how to manage your debt most effectively. And we are the best in the world at that. But we need experts in all these other areas. So we really found that these were the 4 areas that almost every challenge or obstacle we found for folks fell into one of these or a few of these things right here. So I want you to think about that, because in the context of what do I do with that extra money every month? Do I prepay my mortgage? Do I invest? We've got to think about this. So we've simply turned this whole thing around and said, let's help everybody develop a financial plan that they're confident with. All right. Let's make sure you're empowered with the information you need, okay, and the education you need to make the right decisions. So I'm going to move my screen so I can see what I'm talking to you. I have all this in my head, so I got to go by my screens. We want to enable you to make sure you do store your money in the most optimal places. And I put a little teaser over there, safety, liquidity, and return on the screen that you can see, because that is some of the strategy, the actual way we help you make decisions on where to store my money in the most efficient ways possible, right? We want to make sure it's safe. Is it going to be there when we need it most? Is it liquid, right? Am I going to be able to get it when I need it? Is it easy to get out? Use and control of my money is liquidity. And what's the rate of return on that money, right? I do want to optimize, so I want to get the most rate of return if I'm going to store my money somewhere. Well, a lot of people don't have the tools to make those decisions. And so we need to help you with that. And then the fourth one, constantly helping surround you with the right trusted advisors to help you make the right money decisions throughout the year, right? Not just when you raise your hand and you think you need it, but proactive advice in all areas of your money. This was a statistic, and I promised as I was putting this together for everyone, I would not kill you with a ton of stats and make your eyes glaze over, but this was one that really hit home for me and related directly to what we're talking about today. And as you can see, I won't go through all this, but this right here, there was a study done, but 18% of those surveyed shared that they were being significantly impacted on their ability to save for their own retirement because they were helping their adult children financially. If you add the somewhat plus the significant impacts, 43% of all people surveyed by helping their adult children with money were unable to successfully fill up their retirement buckets. And as we're talking about today, 49% of everyone surveyed out there were struggling to pay down their own debt because they're helping their adult children with their money needs. So this told me two things. I have a 16-year-old, I have a 13-year-old. So the first thing it told me is this doesn't relate to me. So I don't know everybody that's watching this, how old your kids are. But the second thing it told me was, how can I learn and empower myself as best as possible so that my children aren't making me sacrifice too much when I get older and they're older. So I need to learn now, not only for myself, but I've got to learn for them as well. So I'm going to pause for a minute before I go to this next concept. Is there any chats, Janae, to touch base on?
Yeah, earlier you asked, why are people here? And we got a few responses. Josh says it is wise/not wise, or is it wise/not wise in the current climate to pay down low interest mortgage or deploy that money elsewhere? John says he's here for curiosity. Jay says, here for a much needed, trusted second opinion regarding home financial management.
Beautiful. All right. Thank you. I love it. Thanks for your input. Thanks for the collaboration. And as you chime in with questions, we are going to, anything that's really personal, we'll point you at the end to your NEO advisor to really dive in, because your answer really is at the end of the day, it's going to depend on your situation, your goals. I want to get you right up to that point, like, oh my gosh, I need you to look at my situation and really customize a solution, a plan for me. But keep chiming in if there's anything that at the end of this we can really tackle. But otherwise, I want everybody to see how everybody else is answering and kind of where you're at in life and financially, but also keep it a safe place, right? And make sure that you can share here, because nobody typically is all alone in their challenges that they've got in life and with money. As much as we might feel like it sometimes, there are so many other people facing the same challenges and struggles with how to manage their cash and cash flow. So I want you to chime in again now. Now that I've kind of got you down to this prepay versus invest, and you're thinking about money on a bigger level, why do you want to be mortgage free? Go ahead and type it in. I'm going to give you a minute here. Go ahead and type it in. It could be the most surface basic reason, or it could be something a little more deep of why you want to be mortgage free. What is so important to you about having no mortgage someday at some point in your life? Go ahead and type that in. I'd like to see what people say. Largest payment to wipe out to free up income. Beautiful. Who else? I want to hear what else is important to you about being mortgage free? That's why we're here today. Early retirement too. I love it. Becoming financially free, able to travel, right? So we feel like that mortgage gets in the way of the ability to travel, more free time, income flow. Yes. Love it. Free at retirement. No obligation to kids when gone. Okay, that's a great one, right? Not leaving a potential debt burden to your children when we're gone someday. Beautiful. Thank you so much for chiming in there. What I find, and think about your answers, and some of you didn't chime in, but you were thinking about it in your head when I asked that question, is I find answers are very emotionally based, or they can be very logically based. Okay. Not leaving a debt to my children probably covers both of those, right? There's an emotional reason for that, and also a very logical money reason for that. And I find a lot of people make these decisions far too based on emotion and forget about the logical aspect of these decisions. And some are vice versa, depending on how you're wired. And it's something I learned a long time ago called the house versus home conversation. And again, maybe that's a future topic, a fun conversation. But when you think of the word house, you think of all the logical aspects of owning this structure, right? Appreciation, a mortgage, a place to work, possibly, repairs, right? All these logical things that come along with owning a house. And then when I would ask people what they thought about the word home, it was all the emotional aspects, right? Having holidays and memories and the swing set in the backyard and having friends over, decorating, right? Painting it, just that emotional feeling of owning your own home, right? Well, we got to balance both of those. And so when you think about your answers and then your decisions, your behaviors around prepaying my mortgage or not, we've got to balance emotional versus logical, of course, always. So I think a lot of this is going to start with making sure you're asking the right question, because a lot of you come into this going, okay, how can I pay off my mortgage faster? Right? That's the name of this event. How do I pay off my mortgage faster? I want you to back up a little bit and first ask the question of, wait, should I prepay my mortgage? And if the answer is yes for you with your situation, great. What's the best way for me to do it? Can we sit down? Can we walk through some options and strategies and help me put a plan in place to do it? For some of you, you might realize, wait, okay, maybe that's not the best thing for me to do. Is it better for me to go and invest this extra cash or cash flow that I have available? Okay, so I want you to ask better questions, because when you ask better questions, you're going to get better answers. To me, the ultimate question is even one level up. What is the highest and best use of my extra cash and cash flow? That's the best question I could ever come up with for myself. Take it away from the mortgage, the house, any emotional things. What is the highest and best use of this extra $500 a month I have? And if it's paying down my mortgage, great. If it's investing, great. If it's paying down some other high interest debt, great. But think objectively about the highest best use of this extra money or this lump sum of money I've just come into. That's the question I love to ask myself. So if that's helpful for you, write that down, keep it on a sticky note. But that is how I make the right money decisions more often than not, by just asking myself a very high level objective question. So the fast track to mortgage freedom, right? The title of today's topic. Well, let me start by explaining what the problem is and why this is where we're kicking things off. Homeowners, you can see on the screen, with mortgages do frequently accelerate the payback of their loan. And that's not the problem. There's no problem with that. The problem comes in when they do so without considering the alternatives, right? Or the impact on their broader financial goals and strategy, right? We can almost say they're doing it blindly, okay? Or just purely on emotional reasons without stepping back and go, wait, why am I doing this? And that's why I asked you the question, why do I want to be mortgage free? Because we've got to answer that question before we just blindly throw extra money to the mortgage servicer. Now, why would they do that? I mean, I wrote down a few of the obvious answers, right? Number one, maybe you just don't like debt. I get that. I mean, you might have come up in a family that despised debt. You were taught to hate debt. Maybe there was financial challenges growing up as a kid. I mean, there's emotional things that get a lot of families to say, we hate debt, we're debt averse, we need to get rid of this debt as fast as possible. A lot of emotional reasons behind that one. Okay. There's a more logical side of things. Maybe and we already had that, but no mortgage payment by the time I retire. And a lot of times, you think about one of the biggest fears that we all have in this day and age is, I got to make sure I don't outlive my money. Someday I want to retire. I want to enjoy those golden years, but I don't want to be stressed about outliving my money, because people are living longer, and a lot of people aren't on track to retire with enough money. That's the reality of it. If you go Google any statistics, people are not on track, which is why we're hosting things like this. But that's more of a logical thing. And then, I look at that third one I shared, because there's a lot of reasons you might be paying extra on your mortgage, but uncertain of other places to store your money, right? That is blind spot number 2, financial literacy, I should say, and storing money in inefficient places. I don't know what else to do with it, so I might as well just pay down my mortgage, because I at least know what that means when I do that. Okay. Doesn't mean it's the right choice all the time for everyone, but it's what you know, so you tend to do it because of just that. So I'm not sure where all of you stand in that area, but I'm going to tell you, it all connects. Every decision you make connects. I grabbed the book right here. It's up on the screen. I read this nearly 20 years ago, and when I was just investing so much time and energy into becoming a financial educator to all my clients. Rick Edelman's one of the top financial planners in the world. Was on Oprah Winfrey numerous times. I think he may have been he's actually the financial planner for Oprah Winfrey. Uber successful, many books. But when I read this statement, of all the books I've read of his, it changed my whole approach even more so. And here we are 20 years later. How you handle the purchase or the financing of your home will have far-reaching implications on virtually every facet of your financial life, including your ability to save, pay for college, and plan for retirement. That packs a punch. Okay, and that became part of every presentation I ever had in front of any homeowners or potential homeowners, because that's how we have to look at these decisions. Okay, if I put money here, it means I'm not putting money over here for some other goal I've got. We have to understand that. Opportunity cost is the official term for that. But I've learned to change over the last 15 to 20 years as we've become liability advisors and gotten certified and really studied and mastered this debt management role. It's also how you handle your borrowing and repayment decisions throughout your life as a homeowner. So not just when I buy a house and I choose how to finance it once every 7 years. It's also every single month when I make decisions to prepay my mortgage or just pay the minimum, that every decision impacts all the other aspects of my financial life. It's that important. So let's drill down and make sure we're very clear about this. Repay or prepay before we get into the invest. Repay. That's simply your contractual obligation that you agreed to pay every month, the principal and interest portion due on that mortgage payment over the next 30 years. Okay, that's just your repayment obligation, contractual. Prepay is literally into the weeds here, but you choosing to pay above and beyond that an optional amount of money beyond that obligation. And typically you're going to do that for the basic reasons of, I want to pay off this mortgage faster, or I want to save interest, or, both together, right? So I'm going to show you some examples of this. So let's just focus on prepaying your mortgage. All right. And I thought, I added this in pretty recently. It's a pretty cool rule, this magic rule of 5.31% that I've learned. And what it means is, for any of you with a 30-year fixed mortgage, if you had a mortgage rate of 5.31%, it means that over 30 years, if you go along making all your minimum obligation payments for 30 years, you will pay back twice as much as what you borrowed originally. Hopefully you got that. So if I borrow $400,000 on day one and it's at 5.31% on a 30-year fixed rate mortgage, and I just pay the minimum for 30 years, I will pay back $800,000 to pay off that $400,000 loan. I don't know, I geek out on some of these things, but that's fascinating to me. If my interest rate's lower than that, I will pay back less in interest than what I borrowed originally on the loan. If it's higher than 5.31, say it's 6 or 7%, I will actually pay more back in interest than what the balance of my loan was. So if I borrowed 400,000, it would cost me more than 400 in interest expense over 30 years. So it's a cool rule to know, because this is a lot of times why you want to prepay your mortgage, because I don't want to pay so much dang interest back to the bank, the lender. So here it is, just spelled out for you. And this is the actual math. So if I had a $400,000 loan and I just did the normal repayment obligation every month of $22.24 a month for 30 years, I will have paid back $800,533 over the life of that loan. Right? So the $400,000 that I borrowed originally, I got to pay all that back, and then $400,500 of interest. So there's that 5.31 rule. If I choose the optional prepayment, I have an extra $500, check out what it does for you. Same rate, same original balance, but I'm going to send in $27.24 every month. I will have this loan paid off in 20 years, and I will pay a total of $647,000 back to the bank. So I got to pay back the original $400 that I borrowed from them, but I will save $153,000 in mortgage interest. That's why people are so adamant about prepaying their mortgage. Okay, now the lower my interest rate, the better all these numbers look. The higher the interest rate, the worse it looks, right? Because I'm paying even more interest than what I borrowed originally. So if we're just talking about prepaying my mortgage and how best to go ahead and do that, then there is some clear numbers. And when you meet with your mortgage advisor here at NEO, like to really give them your mortgage statement, identify how much cash flow you have and what my options are, they're going to be able to kind of look at these different scenarios for you. So let's look at some of these common prepayment options. You know, you've probably heard a lot of these, maybe you're doing some of them, but there's the biweekly, right? The biweekly is where I basically take my mortgage payment, cut it in half, and send that in every 2 weeks. All right. So by the end of the year, I've made 26 half payments, which really means at the end of the year, I've made one extra mortgage payment. That's all that's really doing. But a lot of times after you get your mortgage, they send you solicitations to sign up for biweekly payments. It's really what you're doing at the end of the year is you're making one extra mortgage payment by the end of the year. There's the 1/12 people. All right. I should have named all these folks. I'm going to take my mortgage payment, my principal and interest, I'm going to divide it by 12, and I'm going to add that to my monthly payment every month. Okay. You basically are going to get to the same place because by the end of the year, you paid one extra payment. There's the budgeters out there, right? Where you meet with your mortgage professional and you're going, okay, I've got about 200 extra bucks, or I've got $500 extra every month. I'm just going to allocate that every month. I'm going to send in that extra money every month to my mortgage servicer and pay this loan down as fast as I can. Okay, so that's an option. And then there's the lump summers out there. I just inherited some money, or I had a windfall of money. I got a big bonus check, a big commission, and I'm going to take this chunk of money, 25,000, 10,000. I'm just going to send it in one big lump sum and pay down my loan. That's another way to do it, right? All with the goal to prepay this debt as fast as I can. So how does all this compare? So let me throw in some numbers for you. $500,000 mortgage that you took out a couple of years ago. Let's hope you got in when the mortgage rates were incredible. Let's see, you locked in a rate of 3.5 for 30 years. You've got a payment of $2,245. And we won't go through all these numbers. It gets a little mind-numbing. But on the biweekly, I could pay my house off, my mortgage off a couple years faster, save about $44,500 in interest expense. So that's great, right? The 1/12, right? I take $187 every month. That's 1/12 of my principal and interest, and I add that to my payment. And you can see you pretty much end up at the same place way down the road, about 5 months off. Okay, but I save about the same amount of interest. So you kind of, like I said earlier on the last slide, you end up at about the same place. If you've said, okay, I've got about $500 every month that I'm just going to pay towards paying down my mortgage by prepaying my mortgage, you could pay that thing off in just under 22 years. If you stuck with it and you never miss a month, right? There's some discipline there. And you could potentially save $94,000 in mortgage interest. So there's some huge savings here when you really think about over the course of your life that could go towards other things. Here's an example I put in. Let's say you just you got a big bonus check of $25,000 or an inheritance or what have you, and you've said, I'm going to put it all towards the mortgage. Doesn't save you as much as you'd think. In this example, you will save about $38,000 in interest. Going to knock about another year off your mortgage. Not even that, but it helps. All right. And again, us here at Neo, we've got some really, really, I won't say fancy, but awesome technology and tools to plug in your specifics to these scenarios. I just want to give you a real high level overview of what does it really do for me, right? Well, all these different options that people have told me, my friends at work tell me, my parents, what do they really do for me? Are they really worth it? Which was some of your questions in the chat, which I appreciate. But hold on. There was this really smart guy back in the day. We'll call him Al. He said something really profound that I have really stuck to. Those who understand interest earn it. Those who don't, pay it. And I remember when I first heard that as a young pup, I was like, I want to earn it. I don't want to just pay it. I want to earn interest. What does he mean by this? So I'm going to share a concept with you to just really give you now that we've talked about how to prepay my mortgage and what it looks like and how much interest I could save. Now we need to flip the script a little bit. We've got to look at it from a different lens. All right. And watch the chat, Janae. I'll pause in a minute, but this is a profound way of thinking about this. But for every person who has a rate, there is a return for somebody else. An interest rate and a rate of return are the same number, just from two different perspectives. So I'm going to unpack this for just a minute so it makes sense to everybody, because for me to make a prepay or invest decision, I have to understand this concept, right? So if I walk into my bank and I have $10,000 and I deposit it there in a money market, and they're going to give me 2% return on my 10,000. That is my return, but it's their rate. They're obligated to pay me back 2% on my money. And it's my return because I'm the investor. Same thing applies with mortgages. So if I have that mortgage we just talked about at 3.5% over 30 years, it's a rate to me of 3.5%, but that's a return for an investor on the other end of this, who's making money by my rate that I have to pay them because they lent me the money. So hopefully that makes sense for everybody as I unpack that a little bit. But when I started looking at things through that lens as an investor, I started to realize that this is an investment decision. If I decide to send extra money in to pay down the balance of my mortgage extra fast to the servicing company, this is an investment decision. And that changes everything. So let's go back to this question. Should I prepay or should I invest my extra dollars? And it's going to be different for every single person who's on or who watches this down the road. I'm going to bring back the same exact example. I'm going to ask you a question now. Okay, same mortgage, same interest rate. You've got a payment of $22.45 a month, minimum obligation. All of these options I've got up on the screen that we already talked about. If I send in the extra $187 to the mortgage lender, the servicer, what's my rate of return on that money? Go ahead and type that in. I send them $187, prepay my mortgage. What's my return on that $187?
Stephanie says 0. Josh says 3.5% every time. And we actually have a question from Derek. Is there a break-even point for an even larger lump pay down, like 100K to 200K?
There may be. I'm not quite sure. There's probably some other stuff that goes into that question. Derek, if you mean more specifically, if you can give me more specifics on that question, which slide are we talking about? Interest rate's going to play a factor. You might have been just on the prepaying aspect. Or it might be right now on rate of return. I don't want to go too high level on everybody, or too in depth for everybody. But if I'm paying down $100,000, right, a big lump sum on my mortgage, I still have, and it's costing me 3.5. I still have to understand what else I could do with that money, which is kind of where we're at now. Okay, if I can't do anything better than 3.5%, heck, let's pay down the mortgage. We are getting the ESOP buyout. Okay, then you need to sit down and put these into our fancy tools. Let's just say fancy, because they will help you look at the options side by side, Derek. Take that money and see what it does to prepay the mortgage. And I'm going to show you a case study at the end of this that you can apply the numbers in your mind to this. So that's perfect. Josh, 3.5% opportunity cost. Absolutely. So the answer in this case is 3.5%. Josh, you're spot on. I know some others that are already on our team know this answer. John, 3.5%. Yeah, we're ignoring the taxes and whether or not you're deducting mortgage interest and all that. So that is my return. So if I don't know what to do with my money, and I'm going to take my extra $187 or $500, I'm going to send it in, I'm going to prepay this debt, I have a guaranteed rate of return of 3.5% at the time I pay that debt off. So that's a rate of return now. Look, thinking of this as an investor, that's a rate of return of 3.5. So then the next question you have to ask yourself is, am I happy with that rate of return? Every month, if I have a choice for my $500 or my $187 a month, my $25,000 one time, am I happy over time with a 3.5% rate of return on that money? Now that I'm looking at it through that lens. Some of you are going to say, oh yeah, where else can I do better than that? Some of you are going to say, no, that's horrible. Actually, now that you say it that way, Trevor. Okay, but that's all because you're coming from different places, right? Different experiences. Some of you aren't investing. Some of you are big investors. Some of you have a financial planner. Some of you don't. Some of you, this is brand new to. But this is where we can help you beyond just borrowing new money right now, because you probably don't need a new mortgage right now. But I can guarantee that I have a 3.5% interest or return on my money if I prepay my mortgage. That's fantastic. So let's think about this in this way. What I've learned and what liability management is all about is the location of my money. Now, for those of you that have ever bought real estate or ever listened to real estate professionals out there, because we work with a lot of them, for years they've been shouting from the rooftops, location, right? We've all heard that term. But they were talking about where your house is located, right? Don't make sure there's a railroad track running right through your backyard, or you're in a depreciated neighborhood. It was about the investment on this house is going to be based on where the house is located. What I want you to start thinking about is location of my cash and my cash flow. That $500 a month, that $187 a month, that $25,000. Where should I store my money? What's the best location for my money? And what we're talking about in this example is, I can prepay my mortgage. I can build house wealth, as we like to call it. So I call it house wealth because it trains my mind to think about it as an investment decision. When people say home equity, it loses some of that, right? It's just home equity. But house wealth versus investment wealth, right? I want to be reminded that it is an investment decision. So by prepaying my mortgage, I'm saying, hey, I think the best place to store my money is inside my house and build house wealth. And my return, as we just talked about, is 3.5%. All right, good, bad, indifferent. Or I go invest it and I put it with a financial planner and I take those same dollars and my fear is I don't want it to get lost in all my other investments because I want this mortgage paid off. So something that has worked for us for a long time is, Mr. and Mrs. Financial Planner, here's my extra $500 a month. I want you to put this in an account earmarked for mortgage freedom, whatever you want to call it. But I'm just going to store my money to be mortgage free somewhere else because I think I can do better than 3.5% over time. Yes, there's market risk. Absolutely. I get it. So I gotta manage my financial safety with that in my investment. It's also more liquid. Okay. If I do need it for some good or bad reason, I can get it. But I think I can do better than on a rate of return. Okay. In this case, 6%. And I'm going to show you my case study because this was an actual case study of somebody. So that worked well. So maybe that's an idea for you out there. If you want more liquidity, put the money somewhere else with a financial advisor have it invested, but put it into an investment account that is earmarked for mortgage freedom. And that helps you kind of silo that money. Like, this is for me to be mortgage free by the time I retire. I just want to optimize my dollars along the way. And we always, when you have a conversation with your Neo mortgage advisor, you're going to look at how safe is the money wherever I locate it, whether it's inside my house or over in this investment bucket. How liquid is it, right? How easy can I get it if and when I need it, right? For good times or bad. I have an opportunity to buy a second home, or we want to buy a place for our kids going to college. There's all kinds of needs for money. And so sometimes we forget how illiquid money in the house can be, right? You've got to qualify to get it. You've got to have your credit scores run. You got to pay some fees to get that money back. And that's okay. Just understand the rules of the game. And in this case, I'm talking about return. If I think I can do better than the 3.5% return by taking my extra dollars there, I'm going to go put it somewhere else and try to make a better rate of return, whether it's 4%, 7%, that's up to you, right? It depends on your level of investments and what kind of balancing you want to do, what kind of risk you're willing to take on that money. If we just do the math, which I know everybody wants to see the math, and you're going to get way better math than what I'm putting on these screens, keep it simple for you. But as I'm thinking about rate versus return, if I take the $500 and I prepay my mortgage of 3.5, I will have that mortgage paid off in 261 months, way faster than 30 years. But I do have to understand that I'm reducing my access and my use and control of that money as I do that. So if that's okay for you, then it's going to get you mortgage free really fast. If I've got a financial planner that historically keeps making me at least 6% after tax, and I go give him or her that money, I will have enough to actually pay off this mortgage, if I choose to, in 239 months. But I'm also doing it with increased liquidity, right? I have access to money for whatever may come along that way, right, for the next 20 years. But from a pure mathematical, logical standpoint, I could actually have enough money. I could have enough money in what's that, 12 more months, one more year? No, I'm sorry, 22 more months. Okay, so that's almost 2 years faster by not putting it towards a mortgage and putting it somewhere else. Now, there's two types of risk. There's discipline risk. This prepayment is discipline risk. This investing, right, could be discipline risk and market risk. You got to give that money over to your financial planner every month. Okay, you got to put it in your 401k every month, whatever you're doing with that money. This, you've got to prepay it every month, $500. So think about those. There's risks with all of those options. Prepaying your mortgage isn't without risk. If anybody went through 2008, there is risk with having a lot of money inside your house. I lost a lot of money. People who had money elsewhere were safer, right, during that financial crisis. And we have fancy calculators that all of your Neo advisors will have. I just wanted to show you that we plug in some numbers. We've got this plus a multitude of other cool tools to use for you when you bring your situation to us. But what you'll see here, just as a real simple version, is this blue line right here is you prepaying your mortgage, and it's gone in 261 months. This red line is you choosing to invest those dollars. And when I learned this, it blew my mind on a different way of looking at building wealth through real estate and mortgages and leverage. But when this red line crosses the green line, which is my mortgage on the normal track, when that crosses over and my investment account, my savings is equal to or greater than what I owe on my mortgage, I am mortgage free. I could wire that money tomorrow, pay off my mortgage, and be mortgage free. But I got there faster. I got there in 239 months instead of 261 months. Okay, hopefully that makes sense for everybody. But this is what I call the crossover point or the freedom point. And for you, right, this is something you do every year, but we can show you these crossover points for you depending on your decisions you want to make. So just a really cool example of the tool, that one of the tools we can use and how much interest you can save over time. So I promised you a case study. We're nearing the end here, and you're going to have a little homework I'm going to talk to you about, but here's an actual case study of why I pulled some of these numbers in earlier for some of these simple examples. This was a family, a couple that had a second home, a vacation home, and they were about 18 years off from having it paid off completely. They had a 4.5% interest rate in this case. Their other investments, retirement, all that, and that big bucket of it, investing was making about 6% on average, okay, outside of the mortgage and the home equity. Their goal was to try to have it all paid off in 13 and a half years, okay, by the time they were hoping to have the option to fully retire, right, and be financially independent. Through the review, we identified $500 available to put towards this mortgage elimination goal that they had. All right, so that's the scenario. Option one, okay, which you'll see right here in this second column. I mean, obviously they could do nothing, right? And they'll have the house paid off in 18 years. Option one, though, was to take that extra $500, pay down the mortgage extra fast, and they could have this mortgage paid off in 14.17 years. So not quite 13 and a half years like they were hoping, but they're saving a lot in interest. They would have about $25,000 left over, and then they could make a choice there, right? Maybe they could liquidate some of the things and eliminate it, or just take a little bit longer to pay it off. Maybe they don't retire actually in 13 and a half years. They have options, right? Option two, take all $500 we showed them and invest it instead. Put it with your financial planner, earmark it for mortgage freedom, and make that 6%, continue that over time, put in that side fund, right? And they would have enough money to pay off the mortgage if they chose at that time in 13.75 years. So a little bit faster, not a ton faster, but faster. And as we said earlier, with more liquidity and more use and control of that money along the way, just in case something happens, okay? And then the third option, we showed this couple because they were still kind of wary, right, of investing all that money and not, knowing guarantee they were paying down their mortgage. So splitting the difference, $250 towards the mortgage repayment, $250 towards their investment account. Okay, and they just felt good about that. They kind of balanced out their options. They didn't go all in over here, all in over here. They balanced it out after we had that conversation. And this would put them on a path or trajectory to have their entire mortgage paid off in 13.9 years. So still really, really close. And what you'll see down here, again, I'm not going to go through all these numbers. Your NEO advisor will dissect all these kind of numbers for you. But from a net worth standpoint, that's the real goal here. We have to remember, we're really trying to build wealth and net worth, which is really financial safety, and not run out of money when we retire. So a lot of times when we say I want to have no mortgage, it's because of that. It's what we think is a means to that end. And both the net worths with the house value plus what they had invested minus the balance on the loan was higher with options 2 and 3, investing all 500 or investing at least 250 of that money. Higher net worth overall, which means higher financial safety, higher likelihood of retiring when you want and how you want. So in this case, this family was glad they didn't just blindly take all 500 and pay towards the mortgage, because it actually would have sabotaged their ability to retire when they want, now they want. So it was great that we got to sit down and kind of course correct. They didn't need a new loan. They had a good loan. There was no refinance needed. It was simply, where should I locate my $500 that I have every month? So that's what we want to help you with. This is a final stat that I want to share with you and what really made me want to bring this event to you. 80% of this population, of us here in America, have by far the majority of our wealth, our financial assets, inside our house. Not even close. Okay, that is what, about 65% roughly of your wealth is inside your house, and maybe 15-ish outside of your house. If you want to look at it from an investor standpoint, that's not diversified. And that is most of America. The top 20% of the wealthiest people in the country have by far most of their wealth outside of their house. And when I saw that stat amongst a lot of other things, I thought that would really drive home why we're talking about this today. Because you have a choice every month. Do I send all my extra money into the bank, or do I save it outside? And we haven't talked about that, but be more diversified. Be more liquid, yes, have access to that money if I need it for good or bad times, but also be more diversified, which for a lot of people, that is financial safety, is having lots of different buckets of money. not just all of it inside the walls of my house. It's a very cool statistic that came out. So this is the path, everyone. You were here. You're going to go spend 15, probably 30 minutes with your NEO advisor. All right. Review your current situation, your goals. I'm going to give you some things to talk about here on the next slide. You're going to analyze, right? They're going to analyze the situation, plug it into some of our tools and software we have. Put a plan in place, right? Remember that first blind spot, lack of a plan? Going to get a plan in place for you to make sure you're on the right track. And then you go implement it. And then make sure you check in consistently. Okay. Here's your homework. All right. It's painless. I guarantee you this is good homework. Not like my kids complain about it at school right now. Okay. You're going to schedule a review, 30 minutes with your NEO mortgage advisor. At least have your mortgage statement ready to send over to them so they can kind of see where you're at, the balance, the interest rate, your minimum obligation of repayment, as we talked about. Okay. And do a quick look at what's my other money making me, whether it's in your 401k through your work, your employer, other investments somewhere else. Find out what kind of money that has been making for you over time. Okay. You got to zoom out a little bit and look over time. Okay. And you're going to spend some time reviewing and really assessing what is important to you. What are my goals and dreams with the house, with my mortgage, going forward? This is the foundation of everything, and balancing that emotional versus logical decision making. Okay. So when you meet and then you analyze everything with your mortgage advisor, short and long-term objectives, zoom in, zoom out. All right. How is your current cash flow? Are you happy with how much you're able to save at the end of every month, or is there too much month left at the end of your money? Okay. Right the ship if there is. Look at any other debts you have and prioritize them by highest interest rate to lowest interest rate, and get a plan to get rid of that other debt possibly before the mortgage. Make sure you've got sufficient cash reserves so you sleep well at night. Okay. Consider that safety, liquidity, and return that we talked about. And at the end of it all, at the bottom here, sorry if it's too low for some people, but I want you to really be objective when you ask the question, is paying off my mortgage faster the real goal? Is that really the most important thing for me? Versus some other goals that I've now gotten really crystal clear on, right? Helping put some money away for my kids' college. Man, I got to play some catch up on my retirement savings. I need some insurance. I need a will and trust in place. There's so many things you got to think about holistically. Be open-minded to the fact that maybe right now paying extra on the mortgage isn't best for you. And if it is, put a plan in place of how much. So I'm going to jump over to see what other questions we have. But I just want to thank everybody for coming. Hopefully a lot of people are going to watch the recording of this. So let me open up some chats. Sheila, big 180 here. Need to invest in higher interest vehicle. Pow, wow, I love it. Janae, good. Anybody else have questions before we wrap here? I'd love to hear from you. And we're planning our next event in a few weeks here. We'll get the invite out to you all on that, but make sure you do your homework. Go schedule time with your new advisor. Everyone that's watching this later as a recording, schedule time. Reach out to your advisor who sent this to you. Any other questions we can answer right now? I am here for a few more minutes. No? Speak now, please. I would love to help. Thank you. You bet, Sheila. Glad you were here. Please pass this along to anyone else. How much is a 30-minute meeting with the advisor? There is no cost to this. I'm sorry, I should have made that clear. This is just what we do. There is absolutely no cost for anybody to do this. This is what I said at the beginning. This is how we help people be successful homeowners. So make sure you take the time, take that education, the empowerment that we can provide you. No cost. There you go. Yeah, good question. We do not, this is what we do for all of our mortgage clients and friends and anybody out there to change this industry. How do we schedule the phone call? Whoever invited you, reach out to them directly. Absolutely. Great question. If you need, we will send a follow-up. If you don't know somebody here at NEO specifically, reach out to me. I will connect you with somebody personally to help you out. There you go. Janae just forwarded her email on here on the chat. Feel free to reach out to us in any way and we will get you connected with the right person. in your area, or if you already know somebody, then I'm going to point you right to them, of course. Natalie, great. So glad you were here. So is the idea of your mortgage interest rate equals the rate of return you'd get from prepaying? So if you have a 6% mortgage interest, that's also your rate of return? Yes. If I send $500 in to prepay my mortgage, and my mortgage is costing me 6%, that is the rate of return on that $500, 6%. You got it. Ashley, PhD now on rate versus return. Any other questions? These are great questions. Now they're all popping into your head. I love it. All right, it's 1 o'clock Pacific time for anybody not on Pacific Coast time. Have a great afternoon. Thank you for coming here. Please, when you get this recording, share it with everybody. Anybody you know out there in this country that's got a house and has a mortgage, please share this with them and tell them to watch this. Grab some lunch and watch it. All right, and there's Janae's phone number even. All right, Annabelle, thank you so much. I love doing this. We'll do another one in June. Feel free to send in any topics you'd like us to talk about. I've already got a few lined up. We'll put them on the list, but we will continue pouring into you and helping you be successful. All right, take care, everybody. Thank you for being here. Bye. Thank you, Janae, by the way. Host of the year.